Hello, everyone. This is Rob McDougall from Zhang Financial with your weekly economic update. Today is Monday, July 6th, 2026. Last week, economic data that came out, pretty good. Decent to fairly good, with one notable exception and a big one. So we'll just start with the job opening report last Tuesday. Much better than expected. The expectation was we would have 7.3 million jobs opening, came in at 7.6. So good, another indication labor market, not robust, but certainly not as bad as many feared, particularly with AI advancing as it has. Last Wednesday, ISM manufacturing PMI for June, that was expected to come in at 53.7. It came in at 53.3, so we'll call that a wash. So not bad. Thursday was a big day, and you may recall last week if you watched, I did mention non-farm payrolls would be the number everyone is keying on. That was a negative number this week. So the expectation was we'd have 114,000 new jobs, and it came in at 57. So that's disappointing, no doubt. No way to sugarcoat it, except to say the last 4 months, the average has been 137,000 new jobs added monthly, which, again, given the AI-induced scare that we had regarding labor markets just 5 months ago, it's a pretty solid rebound. So other metrics given on Thursday, initial jobless claims, the expectation was 220,000 new claims. That was a little better than expected at 215. Unemployment rate actually ticked down. Now, we don't put much credence in the unemployment rate, not that we ignore it. It's simply there's a lot of estimates that go into it, and bouncing 10 basis points rounded up or down, markets can react really big to it, and there's really not much substance. I kind of think that's the case here. The unemployment rate ticked down to 4.2%, better than ticking up, but not really that meaningful. Average hourly earnings for June, that also came out on Thursday, in line with expectations, a positive 0.3% month over month. And the last item here, factory orders for May, it was negative. Expected to come in at 2.1, came in at a negative 1.3%. But out of everything we've just discussed in the last 3 minutes, the least impactful data point. So a few other things last week, inflation expectations. We remarked last week how powerful the downdraft has been on this chart, which is not what many would expect with rising gas prices, which have now rolled over. But the inflation caused by the Iran-U.S. conflict starting back in April drove this chart up from about 2.2 to 2.5%. But now the 10-year break-even, which suggests what the inflation rate will average over the next 10 years, it increased a little bit last week. 2.23% is where it came in. It's up 3 basis points, so hardly worth noting, but it did stop a nice downward trend that we've seen for the last several weeks. GDP estimate for the second quarter, this hasn't changed from last week. We did the podcast, I believe, last week on Tuesday, and so we had this new information, which is the Federal Reserve believes second quarter GDP will come in at 1.2%. They'll have another revised update for us tomorrow. But 1.2% following the 2.1% we had in the first quarter would be a pretty decent outcome, since investors are very concerned about any future signs of inflation. So a 1.2% GDP growth would suggest less pressure on prices. Fed funds. In terms of expectations increase, we do have a Fed meeting later this month. The expectation is nothing's going to happen, but there is a 22% probability built into the futures market that we will get one rate hike. End of the year, still expectation is by investors, we're definitely getting rate cuts between now and the end of the year. Only 23% probability of no change from the current range of 3.5 to 3.75, 42% probability of one rate hike, 27% of two, 8% probability of 3 or more hikes. We'll right now just go over very quickly a preview for corporate earnings. This is the area of the market that we're just a little bit concerned about in that it has been so strong and expectations keep going up for earnings, so much so that the equity markets have gone up, and yet the PE multiple on forward S&P earnings has gone down from about 23 times down to about 20.4 times right now. And that's because the earnings came in so strong during the first quarter, and the expectations keep getting ramped up here for the second quarter. Companies start reporting in earnings next Tuesday. Mostly financials will start off. But the expectation is for the second quarter, S&P earnings growth will be over 23%. And just 3 months ago, that expectation was 18.8%. So if there is any slippage there, any disappointment, that would not be well received by equity markets. So out of the 11 sectors, all the sectors except for healthcare are expected to have year-over-year growth. And probably this is probably the best part of this discussion about corporate earnings. What's really driving the corporate earnings? Certainly margins are a big part of it, but 12% or 12.2% is what the revenue earning growth expectation is. So instead of just relying on margin, which has some limits to it, it is very encouraging to see revenue growth of 12.2% for the S&P 500 expected for the second quarter. So let's take a look at the returns in the equity and fixed income markets last week. S&P 500, nice rebound, up 1.8%, clearly led by the Mag 7. Now, Mag 7 have had collectively a tough year so far, but the Mag 7 rebounded, our Mag 7, which is an equally balanced index, it rebounded by about 5% last week. Now, year to date, still slightly negative, where the S&P is up 10%, but certainly that is what drove the market up here in the U.S. last week. In terms of international, the MSCI World ex-US developed markets, very strong week, up 2.5%, up 11% year to date. And emerging markets has continued a very impressive first half run, up a little over 1% last week. So year to date up 24%. Fixed income last week, tough week. I showed you the chart with the 10-year break even. Part I failed to mention is last Wednesday, I believe Kevin Warsh had a conference about his thoughts on his new position as Fed chairman. And one part of the conversation that got a lot of attention, and it's not all that surprising given his background, but he expects to shrink the Fed's balance sheet, which effectively, all things being equal, would cause a rise in long-term rates, because the Fed would be not only letting securities on their balance sheet mature, they would be selling mortgage-backed securities into the marketplace, which wouldn't be great for interest rates. So in total, last week, the 2-year was up 8 basis points. The 10-year was up 8 basis points. Bloomberg U.S. Aggregate Bond Index down 0.5% last week, and year to date, that's what it's up, 0.5%. So economic activity that will be released this week, there's not much this week. It's really a comfortable schedule. Today we had the ISM Services PMI. The expectation was 54.2, about even with what we had seen in May. I'm not sure what the number was this morning, but I'm sure it's pretty close to that. Initial jobless claims, that will be on Thursday, as almost always. The consensus is 219,000. Recall last week was 215,000 new claims. And lastly, the existing home claims for home sales for June will be reported on Thursday as well. For the month of May, that was 4.17 million, expected to be slightly improved for the month of June, up to 4.2 million. So that's it for our recap. We thank you very much for your attendance. We'll look forward to seeing you next week. Thank you.